Welcome back to the Options Academy. In this presentation, we'll discuss a naked option strategy called Strangles. As always, to maximize your learning experience, you can refer to our written article which matches this presentation. What is a strangle? Traders who favor naked option selling, who accept the potential risks and rewards naked options offer, often venture to sell strangles in their portfolios. In this presentation, the strategy will be illustrated with its advantages and disadvantages, and provide insights into the nature of the structure. Here is the good news. If you are familiar with trading naked options, you are already well on your way to understanding strangles. In fact, you are only a step away. While selling out the money option is to a large extent non-directional, it indeed suggests a certain bias on the underlying market. That is to say that the market has a better probability of moving away from the side sold, call or put. An option seller who is writing a put option might have a slight bias that the underlying will more likely take a bullish form rather than a bearish one. An option seller who is writing a call option might hold the opposite opinion. An option seller who is writing a strangle is usually innocent of any such bias. Rather, the seller of a strangle is often estimating that the market will remain trading within a certain range and therefore sells options on both sides of the market. A strangle is created when a call option and a put option are sold or bought at the same time. Often it is an out-of-the-money call and an out-of-the-money put that are sold. If the seller of the strangle is correct and the market remains range-bound, both the call option and the put option will expire worthless, allowing the seller to gain from both sides of the market rather than one, and therefore potentially doubling the return. Let's talk about what a strangle is not. As with other strategies, there's oftentimes one element that is most crucial to comprehend when applying the strategy. In the case of the strangle, it is important to distinguish what the strangle is not. It may be the fact that two options are sold rather than one that leads many to refer to the strangle as a spread. Some traders often refer to the strangle as a spread and therefore refer to it as a limited risk strategy. Well, hear this, and hear this well. A strangle is by no means a spread, and a strangle carries unlimited risk. As such, it deserves the appropriate reverence, alas. It may claim its own in its own time. Let's take a careful look at the risk profile of the strangle and the difference between a spread and a strangle. Like the strangle, the credit spread involves two options. However, an option's credit spread will always consist of the selling of an option and the buying of a second option of the same kind, i.e. two calls or two puts, further away from the money on the same side of the market, thus limiting the risk. The difference between the option strikes less the premium collected will constitute the maximum and therefore limited risk. A strangle, on the other hand, will involve the scale of two options of opposite nature, i.e. a call and a put, often doing so on both sides of the market, above the market and below the market. Three aspects then differentiate the credit spread from the strangle. A credit spread involves selling one option and buying another option. Both options will always be of the same nature, and finally, the options will generally be sold and bought on the same side of the market, though they are exceptions in what is known as the gut spread. A strangle involves selling the two options. The options will always be of opposite nature, and finally, the options will generally be sold on the two opposite sides of the market, above and below, though there are exceptions, and a strangle may be constructed partially out of the money and partially in the money. For the sake of simplicity, and to convey the concept as it is most often used, please refer to the illustration in our written article, which you can find on our website. As you can see, should the market trend strongly to one side, there is no limit to the potential loss, aside of the theoretical scenario of the market going to zero on the downside. In the short strangle, there is no long option incorporated, which caps potential losses. It is true that if the market moves to one side and passes one of the short strikes, some of the potential losses are being offset by the option on the other side of the market, which is now rapidly losing value, representing profit to option seller. Nonetheless, at some point, as the option is depleted of its value, it no longer serves an offsetting factor to the loss and continues to accumulate on the short option, which is in the money. Therefore, the strangle is not a means of limited risk. Now that you have a true understanding of the risk profile of the strangle, let's take a look at some of the aspects that make the strategy an attractive one. In the futures market, when traders sell an option in their portfolio, they are required to have a certain minimum amount of funds in their account. This specific requirement changes depending on the underlying market, the distance of the strike price from the current market level, volatility levels, and more. This minimum amount of funds required is known as margin, or margin requirement, not to be confused with the stock's concept of margin, which is a loan from the broker to the client. When a trader sells an option, a call option for example, he or she have to maintain that minimum margin. If they would sell an additional call option, additional margins will be required, reflecting the additional risk. If, however, the trader would sell a put option with the same expiration date and at the same distance from the money, no additional margin would be required. This is because there is no sustainable scenario in which both the short call and the short put can lose money at the same time. In other words, a trader cannot lose on both sides at the same time. Feel free to call us if you have any questions about this point. The margin system, therefore, calculates the margin required on each option and posts the larger requirement and only it. The margin system always relates the margin that is needed for the position it determines as the most risky position. The margin for the options position calculated as less risky is not manifested. Furthermore, because selling an option results in the collection of premium and thus may offset some of the risk of the trade, the selling of an option on opposite sides of the market actually reduces the margin requirement. Therefore, by selling a strangle rather than a single naked option, the margin required for the trade is reduced and the potential return on margin increases. This philosophy may prove beneficial if accompanied by good risk management to employ during periods of time when the underlying markets violate such ranges. The lack of such risk management might prove an expensive lesson. While it is clear that range-bound market conditions are best for strangle traders, the $64,000 question is volatility conditions. Some options writers prefer to sell options when volatility is low or moderate, while others wait for volatility to increase and only then initiate their trades. We don't take a position that one is necessarily better or worse than the other. It is very important to understand the give and take that each school of thought or circumstance offers. Let's talk about strangles and high volatility. During times of high volatility, options premiums are often inflated and options are overvalued. Thus, in highly volatile markets, one can sell the same options and collect more premium, or collect the same premium and sell options farther away from the money, increasing the probability of the options expiring worthless. In addition, once volatility calms and returns to status quo, the options values would be deflated as premiums surrender and retreat from being overvalued back to being fair valued. Lastly, many traders consider the nature of the market, any market, to be cyclical. They assume, therefore, that it is better to initiate options selling in times of high volatility, expecting the volatility to diminish and with it the value of the options. These traders would state that initiating options selling during times of low volatility might increase the potential for loss should the cycle of volatility reach a bottom and start turning. Under that scenario, options which were sold at fair value or undervalued premiums will now become inflated and overvalued, thus representing potential losses to the seller. On the other hand, the disadvantage of a highly volatile market is, well, its volatility. Strong and unexpected market moves that are caused by volatility raise the potential of loss when options increase in value against the seller and or expire in the money. Large moves in the market also increase margin requirements and decrease the staying power. And finally, in times of high volatility, adjusting positions and risk management may be much more difficult than in times of low volatility. Let's take a look at strangles and low volatility. During times of low volatility, the market tends to move in a tight, range-bound fashion. The disadvantages of selling options in low volatility were just mentioned, namely selling options for fair valued or even undervalued premium as opposed to overvalued options and running the risk of a sudden increase of volatility. On the other hand, traders who prefer selling options in moderate volatility stake their claim, proposing that time decay erodes the option's value regardless of volatility. In fact, oftentimes the value of an option will decrease more rapidly in times of low volatility. It has been said that selling options in times of low volatility might resemble watching the grass grow. As to the notion that the cycle of low volatility will undoubtedly end and give way to a sudden, large move in the market. A good risk management plan, which is strictly followed, may very well offset and prevent an unacceptable loss. In conclusion, the strangle strategy is the next logical step for traders who sell naked options. Its advantages lay mainly in the healthier premiums collected and the leverage or superior potential on your dollars, the funds you dedicated for specific trade. Directional traders can utilize the strategy, but nonetheless, the strangle aims to benefit from a market which trades within a range rather than from a one-way trending market. Some traders prefer selling strangles when volatility conditions are low, and hence counting on greater probability for a win. Some traders rather sell options when volatility is high, which allows them to collect higher premiums and or sell further away from the money, expecting the cycle of high volatility to end and allow their options to expire worthless. For those of you who gravitate towards the strategy, we recommend a strict risk management program to be followed rigidly. Here's to your success. And remember, there is substantial loss in trading futures options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. Hope to see you again soon.